Howdy, Jacob here. Today we're looking at a commercial vehicle group in the machinery industry, 128 million market cap on 213 million enterprise value. A very small company with 7% insider ownership. Not terrible. You do have some companies that have more insider ownership, but for a small company like this, 7% is fine. Again, that statistic is basically just to show you, to make you more confident in owning a smaller business where management, like the board, CEO, CFO, who actually own the business, are going to do what's best for you as the shareholder because they themselves are significant shareholders. But anyways, 4 PE, 0.8 price to book looks pretty cheap from that perspective. Growth is very minor. We are seeing a very cyclical business, minus 19.8% revenue. Next year, 14.1. Next year, 18.9. 2 years later, minus 20%. Next year, 35%. So you're looking at a pretty cyclical business, but honestly, if you were to smooth it out, it's looking like low single-digit growth rates on revenue with a relatively flat gross and operating margin, both really low. Gross margin in the low teens, maybe 12, 11%, operating margin in the mid to low single digits. Return on invested capital historically is averaged pretty low. Recently, 16% in the most recent year. But again, it's a cyclical business, so you're probably averaging mid single digits. Balance sheet shows 38 million cash on hand, 15 million short-term debt, and 126 million long-term debt. That long-term debt is almost half of what it was 10 years ago, so they are paying down debt. Their cash flow statement has free cash flow averaging maybe 25 million. So that would be about 5 years of that 5-year average free cash flow to pay off that long-term debt. It's fairly significant, especially in relation to the size of the business. The enterprise value is almost double what their market cap is. So they do have quite a bit of debt, but they have been paying it off, net paying it off, 7 of the last 10 years. So they are trying to lower it. Their other use of cash isn't really shown here. So a little bit of net acquisition in 2019, but really just paying down debt at this point and funding their losses. So this will be kind of lackluster. This would be a company I'd want to get at the extraordinarily cheap side. Maybe 0% revenue growth. Well, let's do 2% revenue growth. Let's do 8 on the P and price free cash flow due to maybe at the end of 7 years, growth is almost nothing, and the enterprise value is still going to be a bit above their market cap, especially from a percentage standpoint. Their margins are pretty low. Let's do roughly in line with averages here, 2.5 a pop. Share change, stock-based compensation at about 4 million is going to be about a 3% increase. So with these assumptions, I would need to have the company fall almost in half to get to the return I'm looking for here. Again, with a company that doesn't have a lot of growth and you're basically just hoping that it goes to its market value, you're going to have to buy it extraordinarily cheap. Because again, it could take, let's say you bought it for half price, maybe the business even went down 10%. If it goes up to that price that it's actually worth, you're still only getting 80% in 3-4 years. That sounds fantastic, but the business, being as cyclical as it is, could also harm that investment as well. So it's a lot easier to make money off of a great company where you just sit back, lazy approach, don't do anything. It's a lot more difficult to make money on a business that you're trying to just buy it for half off and then get to fair value. Because one, it's difficult to really calculate that fair value. People are going to be wrong half the time. Even a great investor like Warren Buffett's wrong half the time. And so it's difficult for especially the average investor to really be right all the time. And so that's why it's easier to have Tom on your side. But again, either way, this one's going to need to fall a bit more before I get more interested in it. Hope you enjoy the video and have a great rest of your day. Thanks.